Welcome back to another video. Today we're going to be taking a look at the stock to real estate valuation, as it is currently the most overvalued it has been throughout history, even more so than the dot-com bubble in 1999 and 2000. We're going to be discussing whether or not stocks are actually a good investment at this current stage versus real estate, as there is a lot of talk about a potential recession around the corner. We'll be going over the stock to GDP valuation as well, which is the famous Buffett Indicator, to sort of analyze whether or not stocks are overvalued in a general sense, not just against real estate. If you're new to the channel, my name is Ian Phillips. I'm a realtor in Southern California, and I love going over housing data, talking about the economy and how it relates to housing as well. If you're interested, subscribe for more, and let's get straight into the video. Okay, so this is the stock versus real estate valuation. And as you can see, it's the S&P 500 index against the Case-Shiller Home Price Index, or the median home value sold, not new construction, but existing homes. And as you can see, throughout history, it sort of goes through these periods of overvaluation. This is the famous dot-com bubble, where stocks had roughly an 80% market crash. And this is the financial crisis right here, where it was primarily led by a real estate crash, and it was essentially buy one, get one free. But as you can see, even during this time, stocks crashed more than real estate because the valuation of stocks to real estate declined rapidly. And we're not going to touch too much on the Great Depression in 1929 because it was 100 years ago. So I want to zoom in a little more on recent history and see where we stand right now. So as you can see, the stock to real estate valuation is the most overvalued ever. Even when we got this 20% market crash in a matter of a month earlier this year, you can see it actually brought the stock to real estate valuation down quite a lot, but since then it has just made a new all-time high. As no surprise, the stock market is now at an all-time high. A lot of people are throwing around this idea that we are in a stock market bubble because some valuations are the highest they've been, even more so than the dot-com bubble. And if we look briefly at the Buffett Indicator, we are in fact the most overvalued in history relative to GDP. So when people throw around this idea of the fact that we could be in a bubble, there's actually a lot of data backing this up, as there are so many stocks that are significantly overvalued, more so than they have been throughout history. But when we look at periods like the financial crisis, which was brought on by real estate, bad mortgages, people taking out loans they couldn't afford, we still saw stocks crash more than the housing market did, which is clear right here when we had the stock to real estate valuation at around, what was this, 8.8, and it went down to 5. So stocks dropped substantially more than their real estate valuations. And something I like to recommend to people, or at least get people to start thinking about, is de-risking as you get older. When you're younger, you can have a lot of your money in the stock market, as historically it does bring better returns than owning a house, owning an investment property. But you do lose out a lot of those tax benefits from owning real estate. And particularly in California, where I live, where your property taxes don't adjust to the market value of your home, they stay based on the purchase price. Owning a house in a state like that is amazing to have that house forever, essentially. In other states, you do actually get your property taxes adjusting to the market value of your home. So people who bought a house 10 years ago, they're paying double the property taxes they are now. But that is for a completely separate video. Now, what's interesting during the dot-com bubble, when we had the stock to real estate valuation at around 15, which is pretty high, it dropped all the way down to a 6.3. Now, at that same period of time, we had the stock market, particularly tech stocks, crashing around 80 to 85%. Some companies don't even exist anymore. In fact, a lot of companies around that period of time don't exist. And the housing market actually did nothing. So even though we got unemployment increasing, the stock market crashing 80%, we had home values remaining constant during this period of time. They didn't go up and they didn't go down. And that has kind of been my base case scenario over the next few years, is I think the real estate market is just going to have more of a neutral, maybe 3% appreciation. Maybe some areas appreciate more, some areas have a little bit of a downtrend, but ultimately I think the housing market is just going back to more of normalcy. but I do believe the stock market is pretty overvalued, and I'm actually planning on selling my entire stock account later this year, potentially into 2026. I want to kind of wait and see how some things play out in the economy over the next 3 to 6 months, let's say. But if we do sort of establish where we are right now, I'll zoom in a little bit. We are extremely, extremely overvalued in terms of where the stock market is right now and where home values are relative to stocks. And it kind of tells me that if you're someone who wants to de-risk, take a little bit of those gains off the table, because let's face it, the stock market is up around 180% in the last 6 years, which is very, very abnormal. Even though I only started investing in the stock market maybe 6, 7 years ago, that does not seem normal to me. And I'm talking to a lot of people who are new investors this year, new investors last year, and they think they're just going to get 15 to 20% appreciation every single year for the next 10 years. And because they're used to that for the last 5 to 6 years, they just think that's going to continue to happen. And in my opinion, through the extensive research that I do in the economy, it's kind of an obsession that I have. I think the stock market is more than likely going to have a couple years of trending downwards. Maybe I'll make a separate video on the stock market. So when I see valuations like this, where we're sitting at almost 19 times more overvalued to real estate, I don't understand why someone entering retirement, someone who has seen an enormous amount of gains in their retirement accounts, in their stock portfolios, would not consider taking some risk off the table and putting it into something that could cash flow like real estate. If you don't want to buy a house, maybe even a government bond could be a good option. I think high yield savings accounts are giving like 4.5% every year right now. So that to me is even a safer option. But in all honesty, the downside of converting your stocks into real estate, let's say the stock market continues going up, the economy continues to boom. You still take advantage of appreciation, because those assets that you sold from the stock market into real estate, the house will continue to appreciate as the economy continues to thrive. And if the economy takes a little bit of a downturn, stocks without fail have more pain compared to the housing market. We see this throughout history. Every single recession, the stock to real estate valuation absolutely crashes. This was in 2021, when the stock market dropped around 35%, and home values had a 10 to 15% correction countrywide. Some areas a little more, some areas a little less. But the scary thing is actually entering more of a period like this, or a recession like we had in 2008. And technically we did have a recession during the dot-com bubble, but it was short-lived and primarily only impacted the stock market. As we know, real estate didn't really do much for around 3 years, even though we had huge amount of unemployment, stocks crashing 80%. Somehow the housing market held up very well. And as someone who values de-risking, especially like I mentioned, as you are getting older, preserving that wealth becomes a priority. And putting that into something that could cash flow into an investment property, maybe you're a renter and you're looking to get into a primary residence, that is a great way of converting your stock account, using it as a down payment toward owning a home, which we all know is one of the safest investments you can have, because we implemented so many more risk tolerances after the 2008 financial crisis that giving out bad loans is almost impossible right now. There's so many requirements to qualify for a mortgage that even if we did have a housing correction, it wouldn't impact the entire country. So if you're buying in desirable areas, if you're buying in safe places, great schools, that area is always going to be desirable, because whether you are part of this group or not, typically families are the main group that are buying homes. Whether it's an investment property or a house, a primary residence, families value safety, they value good schools, and they value desirable areas. So if you are thinking of de-risking from the stock market into a house, you should consider areas that have a significantly larger buyer pool over the next 5 to 10 years. Now, going back over the Buffett Indicator, which is the Wilshire 5000 to GDP ratio, and we are currently at 200%, which are levels we have quite literally never seen before. Okay, we touched them briefly earlier this year, right before we had a 20% stock market correction, but we are back to these extremely overvalued levels. And we sort of almost got to this stage in 2021, right before we had the 30% market crash in 2022. So it sort of tells me that when you're at these levels, it is definitely a sign to be a little cautious. And during the dot-com bubble, we got to 136% overvalued relative to the country's GDP, which is a little concerning, especially because we know that the stock market had an 80% crash around the dot-com bubble. And then during the financial crisis, where we were 100% overvalued, stocks also had a 50-55% crash at that time. So the levels that we're at right now, I'll zoom in a little bit. You can see that it is looking a little concerning, at least to someone who does own stocks and is up quite substantially over the last 5 to 6 years. I personally would love to sell some, take some of that gains, put it in something safer. Considering we are the most overvalued in history relative to the country's GDP, and there are a lot of uncertainties looming in the background of the economy right now. I don't like all the headlines I'm seeing with layoffs. Unemployment has yet to be affected, but we do know that it can take 6 to 9 months for those layoff numbers to actually hit the real unemployment. So there are a lot of unknowns happening, and as someone who values de-risking, especially as you're thinking of entering retirement, as you get older, I think it could be a good idea to de-risk some of your stocks into a house, into an investment property, if it's a good deal, if it cash flows. There are a lot of markets right now where homes are sitting for 30, 60, 90, 120 days, having price reductions. You can get yourself into a good deal using some of those gains we've seen over the last 5 to 6 years. I don't see that being a bad idea. Like I mentioned, if we avert a recession, that doesn't happen, stocks continue going up, house prices will also get some of that appreciation. So you're not really missing out too much if we do manage to avoid some sort of dot-com bubble, some sort of crash in the economy. Just converting some of that into a house could actually allow you to preserve significantly more wealth down the line. But that's it for the video. Let me know your thoughts in the comments. Once again, my name's Ian Phillips. I'm a realtor in Southern California, and I love diving into the data, talking about the housing market, the economy, and potentially getting into the stock market as well. So if you like this video, subscribe for more, and I'll see you next time.